Hello, in this lecture we're going to work a problem related to a partnership. We're going to take a look at the creation of the partnership and the allocation of income, and we're going to look at it in terms of the book financial statements on this side, and then we're going to make adjustments for the tax financial statements, focusing in mainly on the capital accounts. So what's going to be the difference between the capital accounts on the book basis, capital accounts on the tax basis? That's often going to be something we need to keep track of. We're going to keep track of it by having two sets of books here. One will be for the book basis, one will be for the tax basis. That way we can take a look at it in terms of journal entries and try to balance things out in that way, a way that I'm more used to as someone who started out in the accounting profession here. So then we're also going to take a look at it in terms of the table, which we will often see when we're taking a look at basis calculations, whether they be tax or for the books. We're often going to see it in terms of a table. It's nice to tie that table up to maybe a trial balance to see that it's in balance, or how it might work in terms of balancing. So we'll take a look at it in both ways here as we go. So after we do that, by the way, we will also put it into a tax return just to give a simple overview of how the information would work within a tax return. Remember that the partnership is a flow-through entity, so they're going to have to file a partnership tax return and then the K-1. And we want to look at the different types of incomes as well. So we want to see how the income is going to go from the partnership return to the K-1 and then go to the individual return. And we'll take a look at those actual documents as well. All right. So first they're going to start the partnership. Partnership contributes. We have three partners, A, B, and C. Partner A and B contribute cash of $100,000, and C is going to contribute land. Now the land is worth $100,000 because it's going to have a fair market value of the 180 minus the loan that goes on the books, but it has a cost basis of 70, so that's going to be our first kind of complication. We're going to put these three partners on the books at the same time in one journal entry at this point. So I'm going to say the cash is going to go on there. Let's do that first. We know that's going to be an easy piece of the entry, and there's going to be $200,000 in cash, so it's going to be the 100,000 times 2 for the two partners, 200,000. We got the land is going to go on there. So I'm going to say land on our trial balance. Land is going up. It's an asset. It's going up. So they contributed land rather than cash. C did. And the question, of course, is going to be, well, how are we going to put it on the books? We're going to put it on for the fair market value, or are we going to put it on for the cost basis? Now, when we think about the book value, when we think about the financial statements, let's put it on at the fair market value, and then we'll adjust it for the taxes. So we're going to put it on, at this point, the 180,000. And then we're going to have the loan related to the land. So the land went on the books. There's a loan of 80,000 on it, which the partnership now has responsibility for. So we're going to say the loan on the land is going to be a liability. So we're going to have a liability in the partnership now, and that's going to be a credit, increasing the liability of 80,000. So 200 here, and then the 80 minus is another 100. So we got the 300,000 kind of value that has been put in there. Now we've got our three partners. We've got A, B, and C capital/basis accounts. So we're going to say, okay, now we're going to put that information in here. And A and B are pretty straightforward. Now remember, capital accounts have credit balances. I'm going to represent credit balances with negative numbers. A and B is pretty straightforward. They put in 100,000 each. So there's 100,000. There's 100,000. That offsets that 200,000 of cash. And then C, we've got the fact that they put in the 180 minus the 80 here. So we could think of C, we could put it on there as basically two entries, but it's basically the net of those two. So that's going to be the other 100,000. So that offsets the 100 here and the 80 there. That's going to be our journal entry to put this on the books in a book basis. So we're going to say cash. I'm going to go ahead and post this. So we are in S3. S3 equals the 200,000, increasing to 200,000. Then we're going to go to the land down here. Land is an asset. Land's going up in the partnership to 180. And then we have the loan on the land, the liability. So the loan on the land is down here in S9 equals the 80,000 liability, increasing the liability to 80,000. And then we've got the three partners. Three partners. A is going to have the 100,000. B is going to put in 100,000. And C put in the land minus the loan, 100,000. So those are going to be the starting off entries that we will then have. Now, we're going to have to adjust this for the fact that when the land goes on the books for the partnership, we're not going to put it on the books at the fair market value. We're going to put it on the books at the cost basis, because if we don't, you would think that the person who put it in would have to recognize a gain or loss depending on how much the value is when they put it in there. But it's not really a sales transaction because the owner still owns a piece of it. That's why we're going to put it in at the basis for tax purposes. And then when they sell it, that's when they're going to recognize the gain or loss. So that means that this 180,000 land for tax purposes, we're going to basically bring it down to the cost basis, the 70,000 here. So I'm going to call this a tax journal entry, and it always tries to put the in there when I do that, but tax journal entry. So we're going to have that, and I'm going to say that the land is going to go down because I got to bring it down to the value on the books, and we're going to take it out of C's capital account for taxes. So I'm going to put it here for taxes, and we're going to have the difference. It's going to be 180,000 minus what we put it on there for. I'm sorry, we put it on there 180,000 minus the 70,000. That's what we have to bring it down for. So this 180,000 now needs to bring down to 70. Therefore, we're going to reduce it by 110. So I'm going to do that. We're going to say this is debits and credits for the land is going to go down. So let's post that out. So if we go to the capital account for C in the tax adjustment now, we're going to say the capital account is going to be reduced. We're going to say that equals the 110, and therefore C only has a capital account then of the 10,000. If we go up to the land up top, we're going to say the land is going to equal the 110, and that brings the land down to the 70. That's where we're at this point in time. Now, there's one other thing that has to happen with this one journal entry, and that's the fact that if this loan is going to be assumed by the other partners, we're going to increase their capital accounts for the fact that they're liable for the loan on the tax basis again. So this is going to be a tax journal entry again. So I'm going to say this is another tax journal entry. We're going to increase the three partners' bases for the loan here. So the loan, these partners are going to have to go up. Their capital accounts are going to go up with a credit. We're going to increase their capital accounts on a tax basis. And I'm just going to put it into an adjusting account here so that we can see this adjustment in a balancing type of account on our trial balance. I'm going to copy this and paste that here. So we have to include this in the equity section in order to balance this out. And that's going to be for the 80,000. And we're going to get 1/3 of that to each of them. So 80,000 divided by 3. It's not even, but it's close enough. That's what we have. So we're going to say, all right, this is all in the equity section. It's in the tax side. We're adjusting the capital accounts here. We're going to say this equals the balancing account. And then each partner is now assuming 26,667, increasing their balances, and 26,667 here. So here's what their capital accounts are in terms of the tax basis. Here it is on the books because of this two adjustments we have here. One, the cost of the land is going to be carried over so that we don't have to recognize any gain or loss when the land is contributed. And two, the assumption of the liability now being assumed by the three partners. Now, if we look at that in terms of a table, we could see that over here, these transactions happening in terms of a table. Remember that A and B put in 100,000 each, so their capital accounts are going to go in 100,000 each. No difference between the tax or the normal capital accounts. And if we total that up, then that's what we have so far. Here's our running balance. I'm also going to, well, I'll leave it there. Let's put the total down here. I'm going to total them up down here too for now and sum this across. That's what we have so far. Okay, and then the land went on the books, and we're recording the tax basis in this table. So we're not going to put it in there and back it out like we did over here. We put it in there for 180, then we backed it out. This tax basis, I'm just going to put it in there as the tax basis. The land is 70,000. So there's the tax basis table, which ties out to, of course, the tax basis here. And then we have the debt. So the debt on the land was 80,000. So C's capital, 80,000 is going to be reduced. And then we have the debt allocation of the 80,000. So 80,000 to the three partners who are now assuming it. So this is going to be the 80 divided by 3. And C is going to get that back now. So that's how in a table format we'll see the same numbers. So we got these numbers here reflected in a table. These are credits, of course. These are positive numbers in a table type format. And we can then move forward in that. So notice we have the book numbers here and then the tax numbers over here. All right, next thing that's going to happen is principal payment on the loan. So then, just theoretically we might ask then, of course, well, what's going to happen if we pay off the loan of the 6,000? Well, if we and we're not going to talk about interest. I know you're probably thinking, well, we have to record interest. We're only paying the principal off so that we can see what would happen. There's no effect on interest. Obviously, interest would just be debit interest expense and not a problem in terms of what's going to happen to the capital accounts. But the fact that we allocated this 80,000 to the partners, if we pay off the principal, then we're going to have to fix that allocation. That's why we're going to deal with a principal payment on the loan to see what will happen. In order to do this, I'm going to unhide some cells. I'm going to highlight from E to Q, let go, right click, and unhide. Oop, I hid them. I'm going to highlight from D to R, right click, and unhide, not hide. And then we could then hide these cells. I'm going to highlight from E to B, right click, and hide. And then we're going to hide these cells from L to P, let go, right click, and hide. Alright, so now we have a place to work here, so we're going to say that the 600,000, we're going to pay the 6,000 on the loan. So we're going to pay it with cash. So cash is a debit, we're going to make it go down, doing the opposite thing to it, which is a credit. So I'm going to put that on the bottom, we're going to credit cash, and we're going to credit for 6,000. Then we're going to debit something, and we're going to debit the loan in this case. So we're going to say the loan's going down. Loan has a credit balance. We're going to do the opposite thing to it to make it go down. Now, if we post this out, what will happen? Well, if we go to the loan, I'm going to double click on it, go to the end of it, and plus, and go to this loan amount here. And of course, the loan goes down to 74. If we go to the cash, I'm going to double click on it, go to the end of it, and plus, and then the loan goes down, the cash goes down to 194. Now, the other thing we're going to have to do here then is, this was an AJE, is have a TJE tax journal entry to account for the fact that now we paid off part of that loan. So now we're not allocating the 80,000 to these partners' accounts to increase their capital accounts for the basis accounts, I should say. So we have to take that 6,000 out. So same thing's going to happen here. We got these three partners. We're going to reduce their capital accounts for the tax basis. So these are going to go down. These are credit balances. We're going to reduce them. So I'm going to paste 1, 2, 3. And we're going to put the difference to this adjustment account just so we have a balancing account here. And this is going to be the credit of 6,000. And then each of them are going to get 6,000 divided by 3. I'm going to make it a positive number, 2,000 each. So 2,000 each, debits equal to credits. So this is the adjustment we'll have to make on the tax side of things. We're going to say, all right, we're going to reduce the tax basis by the 2 so that their capital account is going, or their basis account is going down for taxes, like this. And then I'm just going to reduce the balancing account so that we have that here, and everything's back in balance down here, all green zeros. So we are back in balance. Now, let's go ahead and see that in terms of a table then. If we go over here and see that in a table. So here's the information, and we have the principal loan here. So we're going to say the 6,000. So I have a total, I have a subtotal here, and then we're going to start down here. We're going to say 6,000 here, and I'm just going to take that equals this divided by 3. So we're reducing the capital account. So here this isn't debits and credits on this side. This is a plus and minus, just calculation of the capital accounts. But this is of course in terms of debits and credits. Here's our ending balances down here, 124,667, 124,667, 14,667, 124,667, and so on and so forth. So you can see it both in the table format as well as balancing out in a debit and credit format. All right, so that's going to be that information. Next thing we're going to record the income, the activity on the income statement basically for the year. So we're going to have one balance sheet account. That's going to be our balancing account.